All right, now we're ready to discuss the Greeks. These are all the factors that affect options. They will help you understand how an option is going to behave. Think of the Greeks as numbers there to help you decide if an option is good, how much it can move given the stock market, and much more. Let's jump into my screen. I'm going to be sharing with you all of the different Greeks, what they mean, and much more. All right, so the first Greek is delta. I'm going to open up a stock. It can be really any stock. I'm going to open up, let's say, Alibaba. I've been a fan of Alibaba in February. Doesn't matter if you're watching this in the future, by the way, it's the same thing. That's the beauty of options. They literally are the same thing over and over. There's no difference in how to trade options. So I'm gonna go to trade Baba options. Okay, you guys are very familiar with the option chain at this point. I'm gonna click buy call option. I'm gonna stay on that and I'm gonna pick March 18th. Now, I'm using Robinhood. You can use many different platforms. It doesn't really matter. The Greeks are the same. So say I pick an option at the money, $107. Now I'm going to scroll down and I'm going to discuss all of this stuff right here. So the first one is delta. Delta is one of the most important and tells you how much an option is going to move in relation to the stock. So if delta is 0.5 and the stock moves $1, it's going to move 0.5. Here, the delta is 0.55, which means that if Alibaba moves up by $1, this option will move up by 55 cents, which is pretty crazy because a $1 move in Alibaba is going to be like something very small, like 1% in the stock, right? The stock's only moving 1%. However, the option is moving 55 cents, and because the option premium is 655, this is almost a 10% rise. I mean, it's probably like 8 or 9%. So the stock can move $1, which is less than 1%, and this will move the option by 55 cents, which will move the option by almost 10%. So here is the beauty of option trading. You get a lot of leverage. You get a lot of power here because you don't have to buy 100 shares of Alibaba at 106. You can buy this call option. And even when Alibaba moves up by $1, you're going to be making about 55 cents on the dollar or about an 8% return, which is a really high amount. And this is also why I tell students you don't have to hold until expiration. You do not need to hold this $107 call option until expiration. Say within, let's say 1 day or 2 days, that this stock moves up by $3. Well, if Alibaba moves up by $3, do the math. Tell me how much money that would be. Pause the video if you have to. All right, so hopefully you got your answer. So about $3 times 0.55 is going to be over $1.50. $1.50, it's gonna be probably $1.65 or something like that. But $1.65 is literally a 25% move or thereabouts on the option premium. So although the stock will move up by $3, the option will move up by $1.50. And that translates into a lot of money because the premium is so small. Now that's easy enough, right? Delta tells you how sensitive an option is when the stock changes price. Delta also has a second meaning. Delta gives us a measure of the probability that an option will expire in the money. So an option with a 0.5 delta can be thought of as having a 50% chance of expiring in the money, and an option with 0.9 delta is interpreted as having a 90% chance of expiring in the money. Being armed with this knowledge, you can now see that you have great control over how much risk you take with an option. All you really have to do is look at the option's delta, and you will know right away before you buy or sell the chances that the option will expire in the money and how the option will behave. The delta of an option ranges in value from 0 to 1 for calls, and a 0 means basically forget about it, it's not happening, and a 1 means you have a 100% chance of this option expiring in the money. You'll almost certainly be somewhere in the middle. As a rule of thumb, when I teach my students to sell weekly options, I go for roughly a 25 to 30 delta. That has been the sweet spot for me based on lots of research. By the way, you can speak to someone on my team for free if you're interested. See my live option portfolio and trades. I'm going to leave a link to book a call below. So now what I want to show you is when I go for an option that's in the money, say this 100 call option, it's going to have a higher delta than 50 because this is in the money. It has a delta of 0.71 or a 71% chance of expiring in the money, or whenever the stock goes up by $1, this option will go up by 71 cents. So two different definitions: how much an option will go up based on the stock moving up by $1, or the probability the option will expire in the money. So now if I go up, let's say I go up to 110. Before I expand this, can you take a guess? Is the delta going to be greater than 50 or less than 50? All right, so if you guessed less than 50, that is correct. It's 0.47, and that's because this option is out of the money. Now, delta is also used when determining directional risk. Positive deltas are long, buy market assumptions, and negative deltas are short, sell market assumptions. If you have a delta of 50, that means you can expect the option to behave similar to 50 shares of stock. When you buy a call option, you want a positive delta since the price will increase along with the underlying asset price. So basically, having a positive delta is good if you believe the stock will go up. 3 things to keep in mind with delta. Delta tends to increase closer to expiration for near or at the money options. That's because if an option is near or at the money and time is running out, that's not necessarily bad if you're right there on the strike price that you selected for expiration. Now, number 2 thing to keep in mind is delta is further evaluated by gamma, which is a measure of delta's rate of change. I'll explain that in just a second. Essentially, delta is always changing for an option. It doesn't usually stand still unless the stock moves very slowly in the direction that you choose. Then maybe the option delta may stay the same, but typically delta is changing, and that's measured by the second Greek called gamma. We're going to talk about gamma in just a second. Delta can also change in reaction to implied volatility changes. We will discuss volatility later. Delta can be looked at very simply as the probability the option will expire in the money, or the second definition, which is how the option moves in relation to a $1 move in the underlying stock. All right, so now you understand delta. There's 2 definitions of delta, and delta is by far the most important Greek that you need to know. The rest of the Greeks are sort of important, but really delta is 90% of what you need to know for the Greeks. The rest of the Greeks are much less important. But let's discuss gamma. Gamma measures the rate of change in delta over time. Since delta values are constantly changing with their underlying stock asset price, gamma is used to measure the rate of change and provide traders with an idea of what to expect in the future. Gamma values are highest for an at-the-money option and lowest for those deep in or out of the money options. While delta changes based on the underlying asset price, gamma is a constant that represents the rate of change of delta. This makes gamma useful for determining the stability of delta, which can be used to determine the likelihood of an option reaching the strike price at expiration. Now, if any of this stuff sounds complicated, don't worry, gamma is just measuring the change of delta. So let me give you an example. Let's say that Alibaba moves up by $1. Well, if it moves up by $1, gamma is 0.02. So just add 0.02 to the delta. So now the delta is going to be 0.5. Let's say that Alibaba moves up by $2. Well, $2 times 0.0266 is going to be about 0.05. Okay, you add 0.05 to the delta, that's going to be 0.52. All this is saying is that if Alibaba goes up by $2, the new delta will be 0.52. If it goes up by $3, the new delta will be 0.54, 0.55. If it goes up by $10, well, if it goes up by $10, then it will go up by 26 or 0.26, add 0.26 here, and you're roughly going to get 0.73. So gamma is just added to delta. It's always being added. And if it's up by $1, well, you add $1 times gamma to delta. If it's up by $3, you add $3 times gamma plus delta. That's just what the delta will be given the change. Also, it works vice versa. Let's say that Alibaba falls by $1. Well, if it falls by $1, then you can subtract 0.0266 or this gamma value from delta, which is roughly going to be a delta of 0.45. So you're either adding gamma as the stock rises or you're subtracting gamma as the stock falls. A good way to think of gamma is a measure of the stability of an option's probability. If delta represents the probability of being in the money at expiration, gamma represents the stability of that probability over time. A low gamma is pretty good because that means the delta is not going to really change. A high gamma means that the option can change in price. An option with a high gamma and a 0.5 delta may have less of a chance of expiring in the money than a low gamma option with the same delta. Greeks can be very complicated, but the gist here is that the gamma measures change in delta. Gamma is sort of the acceleration in a car. The car is going 80 miles per hour, that's the delta. If you brake quickly or speed up quickly, that would be the gamma. All right, now you understand delta, which is the change in the option's price or the probability the option will expire in the money, and gamma is a change of delta. It just measures the change of delta going up and down. So basically, delta is the most important. Gamma, I almost never use. Gamma is almost not that important, but I'm teaching you everything that I can in this program. So I don't really look at gamma. It doesn't really matter to me 99.9% of the time because all that really matters is delta. delta. Now, the next thing that does sort of matter is theta. And actually, it matters a lot if you're selling options, and that's the way I prefer things. But in itself, theta doesn't really tell you too much. All theta is saying is that the option is going to change by 0.16 theta. Now, theta is time decay. That's how much the option is decaying every single day if you're buying options. And this is how much money you're making when you're selling options. Hopefully that puts something into your head and an idea of why I like selling options so much. The reason why is because I make money. I make theta every single day when I'm selling options. But let's just talk about this buy call option. So this call option will reduce about $16 in value per day. I'm getting $16 because again, all of these figures need to be multiplied by 100 since each option is worth 100 shares. And because you take 100 times 0.16, this is going to be $16. So every single day that you hold this call option, you're going to lose $16 unless the stock is moving up towards the direction of $110. Now again, how much do you need to move up per day? Well, that depends on delta, okay? So if you want to break even and have this option not move at all, well, then the stock has to go up by about 33 cents because half of 33 cents or 33 cents times this 0.47 delta is going to be about 0.16 cents, give or take. So every single day, Alibaba stock needs to move up by about 33 cents for you not to get hurt by theta, because theta is a decaying value. Whenever you buy options, you're paying for something, and that option is decaying as time moves on. So theta continues to decay. Now I do want to show you why I love selling options. I pulled up a couple of charts here on Google and I just typed in theta decay. This is my very favorite chart right here because as you will notice, theta decay continues and it actually speeds up as you get closer to expiration. So this is why I like selling weekly options or monthly options. That's because theta is kicking in. It's really becoming rapid at this point and the option is decaying very fast. However, if you're selling options, say put options, or you're selling covered call options or any options for that matter, then you're going to be making a lot of money since time decay is really kicking in after this 30-day mark. It really accelerates at this point. And this is why weekly options are some of the best options to sell. The curve shows you that theta increases as the option approaches expiration. As a direct measure of time decay, theta is giving us the value of decay per day. The higher the theta, the more money you're making as an option seller and the more money you're losing as an option buyer. So option sellers use theta to their advantage, collecting a little bit of time decay every single day. Whereas option buyers are hoping to make a lot of money and they're hoping to see the option have a 2, 3, 4, 5, and even a 10x return, but they are basically demanding that the stock must rise and it must rise within that time period that they're picking the expiration date. All the strategies of selling, which I prefer, are all focused on theta decay. Now, I don't need to look at this theta decay to understand how much I'm making per day because I don't really care how much I'm making per day. What I do care about is, let's say I sell a put option right here and then I'm looking at Alibaba at 100. Well, it says $3. So $3 is roughly 3% of $100. Now, this option is going to expire in about 3 weeks, slightly less than 3 weeks. So I'm looking at collecting 3% for about 3 weeks. That's about a 4% return on a monthly basis. A 4% return, 12 months out of the year, is going to be about a 50% return. So this is a very safe way of collecting passive income. So when I'm selling a put option, I am looking at theta decay. However, that's not really the important part. What I'm actually looking at is the premium that I am collecting divided by my strike price. So $3 divided by $100 is a 3% return, and 3% return, roughly 3 weeks, again, is going to translate into about 4% a month or about 50% a year. So that's what I'm really looking at. And if you pick more volatile stocks, obviously the percentage return that you can collect can be much higher, even 100% per year. Now, the next Greek is Vega, and Vega is something that I do look at. Vega measures the risk of changes in implied volatility or the forward-looking expected volatility of the underlying asset price. By the way, make sure that you're taking notes because the Greeks are very important and I know they're pretty boring, so just make sure you follow along with me. I promise if you stick through this, you are going to see the light at the end of the tunnel. While Delta measures actual price changes, Vega is focused on changes in expectations for future volatility. Higher volatility makes options more expensive since there's a greater likelihood of hitting the strike price at some point. Vega tells us approximately how much an option price will increase or decrease given an increase or decrease in the level of implied volatility. volatility. Option sellers benefit from a fall in implied volatility, but it is just the reverse for option buyers. They love when things get crazy. I mean, they absolutely love it. So if I look over here, the Vega is 0.09. Now what that means is when this implied volatility right here increases, Vega is going to increase. So when implied volatility increases by 1%, the option price will increase by about 9 cents, which is not that much. Implied volatility is very important. However, a rule of thumb is I just look for implied volatility that's greater than 40 if I'm buying options. If the implied volatility, like in this example, is 63, that's a fantastic volatility. 63 is a very high number, which is why there's a lot of premium to selling put options on Alibaba stock. Vega is important to look at to understand if volatility is high or low, but I don't think Vega is as important as some of the other Greeks. Additional points to keep in mind regarding Vega is that Vega can increase or decrease without price changes of the underlying asset due to implied volatility. That means when the market is expecting more volatility, Vega is going to change even if the stock is not changing. For example, let's say there's a big event or like there's a war in the market currently. Well, that's going to increase implied volatility. And if you were holding call options or put options before, both of those options are going to increase in value. Vega can also increase in reaction to quick moves in the underlying asset. So say the stock blows up by 20% in one day, given some big crazy news. Well, that's also going to increase the Vega or the implied volatility. In addition to the Greeks I mentioned, option traders may also look to other more nuanced risk factors. So that's Vega. It's pretty important in terms of having high implied volatility, but the number right here itself is not that important. Now, option traders do look at more nuanced risk factors, one of them being rho. This figure right here is rho, which represents the rate of change in the options value given a 1% change in interest rates. That is the definition. However, it's just not that important because our interest rates are not really moving. Even if our interest rate moves by 0.25%, it doesn't really matter. It's not going to really impact the options. So rho is something that I never look at and has very little influence over your option trading profits. The four Greeks that I explained are the most important and widely used. Of course, delta is the most important. It's what I look at the most. Gamma I don't really look at. Theta is just interesting to know how much money you're making per day if you're selling covered calls or you're selling put options. Vega is not really that important to me. Instead, I look at just raw implied volatility. I want to make sure that this number is high. The higher this number is, the more the premium will be, and the riskier it is to buy options and the better it is to sell options. However, obviously you can still make money. Let's say that implied volatility is 100, but the stock is expected to have earnings and earnings end up being really good. Well, of course, you can still make money. But as a general rule of thumb, the higher the implied volatility, the more interest I have in selling options and creating that passive income source. All right, so that's Greeks. I'll see you in the next video.